I can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, JPMorgan makes a shocking admission, and that's why we're in front of their building right now. I'm hoping to catch a word with CEO Jamie Dimon, because I want to take you on a bit of a backstory of what's going on in the global economy. Because when you see what's going on there, and then you hear what JPMorgan just said, well, you won't believe either. Let's go to Reuters. We picked today's story up with a headline: U.S. factory orders jump in June on transportation equipment demand. So here what we're seeing is some validation that the global economy, particularly the U.S. economy, is starting to turn around. And that's what everybody is hoping for. And that's what makes absolutely no sense, because when you hear what JPMorgan said, and I show you the rest of the data, well, you'll be shaking your head too. New orders for U.S.-made goods surged in June, boosted by strong demand for transportation equipment and other goods, showing some pockets, keyword pockets, of strength in manufacturing despite higher interest rates. And that's not the issue here. It's not an issue of higher interest rates that's causing problems in the manufacturing sector. It's a lack of demand from consumers who just don't have the money to spend anymore because inflation actually outpaced their wages. But let's continue on. Factory orders increased 2.3% after rising 0.4% in May, and this actually is a pretty decent number, as you can see on the chart here. Now here we're looking at manufacturers' new orders. These are durable goods, and I want you to see that it appears that the economy is indeed kind of starting to rebound with a lead in manufacturing, and this is something that everybody kind of said would happen, that the services sector was so strong that it would uplift the manufacturing sector. But hold tight, because let's go back and look at this chart once again, and we can see that going into recessions, it's not unusual for there to be a bit of a rebound in the data. In fact, we can go back and see that in 1998 all the way through 2000 before it rolled over and went lower. We see that again around 2007 before the global financial crisis hit. So what's really causing this? Well, it's the transportation sector. The so-called hard data suggests the manufacturing sector continues to hang on despite 525 basis point hikes in the Federal Reserve. But sentiment surveys suggest that manufacturing, which accounts for 11.1% of the economy, is in a recession, and that's absolutely true. Now, the Institute for Supply Management, or ISM, said the manufacturing PMI contracted for the 9th straight month in July, the longest such stretch since the global financial crisis. Now, we've shown you that, but let's look at the data, because we don't have the ISM data in the Fed database, but we do have the Philly Fed, which is a wonderful long-term regional manufacturing data set. And here we can see in red, which is the Philly Fed data, that it is actually moving lower despite the fact that the headline government manufacturers new orders durable goods is rebounding higher. Now you'll notice that they don't always move in sync, but they generally follow each other. So one of these then is right. Now the question is the government cooking the books here, or is there really something else underneath the data that perhaps is a one-off or a bit of a transitory event? In some areas, strengths remain as orders here is a key part for transportation equipment. Think of such as Boeing, the airplane manufacturer, jumped 12% in June after rising 4.2% the prior month. Civilian aircraft orders soared a whopping 69.4%, while motor vehicle orders rose 0.9%. Computers and electronics increased, as well as shipments for manufactured goods. So let's now restate this chart by moving that transportation sector, and now we get a better picture that the manufacturing sector isn't rebounding at all. In fact, here you can see in blue, it's actually trending down. It's about ready to contract, and sure enough, it appears to be following the Philly Fed data down, suggesting, as we now know, this was really a Boeing effect on the data. Now, how many more months they'll be able to have such a big number, I don't know, but at some point when that washes out, what we can expect then to see is a manufacturing sector start to contract, which would kind of validate that we are indeed going into a recession recession, because let's come back to this chart and we can see the dot-com bubble, manufacturing contracted. We see it during the global financial crisis. We saw it almost as it actually contracted here as the global economy was headed into a recession in 2015 and 2016, but pulled out of it and then was headed into one again, headed into the pandemic. And here's some more data that kind of just makes what JPMorgan said today, as we'll get to in a bit, completely baffling. As the trans-Pacific shipping rates rise, get this, as carriers make capacity cuts. So if we're looking for demand in the manufacturing sector, well, we're certainly not seeing it in shipping, because if they're cutting capacity, well, it says they just don't have enough goods to ship. Typically, higher demand leads to higher capacity availability, but overall, the past month, liners have focused on tightening service offerings as demand has improved. Here we can see they've quoted multiple participants to see the effects from capacity constraints, and what they're seeing is limited space availability, forcing shippers to book earlier, but that's because they're cutting things. And here you can see down around the bottom that capacity reductions due to an increase in blank, which are canceled sailings, fallout from labor disruptions in British Columbia, and a more optimistic outlook on cargo demand in North America. But the key part is, if there was all this optimism, why are they cutting capacity? Why are we seeing blank sailings happen? Because there isn't the demand there that everybody believes is coming. And many of the new buildings being delivered this year are ships with capacity of 24,000 20-foot equivalent units designed for Asia-Europe service, and that's going to add further pressure to, of course, the capacity problem. And here you can see trans-Pacific deployments are down 12.1% to date. That's a huge number, while Asia to Europe is up 7.6%, with further divergence expected in the months to come, even as more capacity is added to Europe, while capacity was drawn from the trans-Pacific. So you're seeing a shift in capacity here, but the bigger issue is that capacity going to the U.S. is too big. They're actually reducing that to reroute it, suggesting that the U.S. economy is not about to rebound as everyone believes. And it gets even worse if we look at the U.S. rail profits pinched by rising labor costs. But get this, forget rising labor costs. We know that's a factor here, but look at this, declining cargo. There's a big problem. Well, one thing that you shouldn't have your profits pinched by, and that's your trading account, because as we've shown many times, look at our soybean trade here. This is one that many people never traded. And our CTA-Timer Pro, which looks at the machine positioning and that runs a phenomenal historical overlay, caught this big move down and alerted our subscribers twice a week. We did that today. We put out a note to them saying, here's the ones you should be watching to help them use the report. Sure enough, we see the signal trip this day and all the way up and back down, signaling a trade out. That would have been a 10.7% gain in a matter of a couple months. Here you can see the initial trade in on June 9th. The machine started short covering, giving you the option then to start making that trade in. And here you can see on August 2nd, the machine starting to sell, giving you the choice to either sell or raise your stop loss. And again, that came back to a 10.7% gain. Would have paid the subscription for the whole year. It's $1 a day, $30 a month. Link in the description below. Comes with a 30-day money-back guarantee, so you got nothing to lose, but except your trading account should start going up, because we just put out another alert today that should have some big gains for our subscribers. Operating profits at Union Pacific Corp, CSX Corp, and Norfolk Southern dropped at least 12% in the second quarter. Now, these declines have likely peaked, but will continue during the second half, so they're not actually projecting that things are getting better, because there's no indications that the market is necessarily picking up. Again, a sign that perhaps that Boeing data was just a one-off in the report, and that really the manufacturing sector is in decline. The question is how quickly the market recovers. That will be heavily relying on the consumer and how that pans out into the holiday season. So here we've been hearing in the past, it's going to be a second half rebound. And now we're getting the first snippet of, well, maybe it's not the second half, but it's the holiday season. When we get to the holidays, everything will start to turn around. And I think we're going to hear more of that. Say, well, the consumer's just retrenching for a big spend, and then it's going to be a pushback again and another one, because there's no evidence that the consumer is in any position to start spending big, as we'll get into the JPMorgan report here shortly. Consumers are spending more on services and pulling back on buying shipped goods, clearly as something we've noted, as a trend laid bare by 22% decline in imported cargo handled by major U.S. ports during the first 6 months of the year. Now, that has massive ramifications. And I've got some charts here on the next slides to validate what this means. Because when you see imports to the biggest importer in the world go down, it means demand's going down. And if demand goes down, well, you guess what's going with it? Well, if you said price, you got it. That carload weakness has accelerated during the first 3 weeks of the third quarter to a 6% drop compared with a 5% decline in the second quarter, according to weekly reports from the Association of American Railroads. And here you can see imports of goods in blue on a year-over-year rate of change against the consumer price index. And what a beautiful relationship. As imports go up, what do you expect? Price pressures rise. As they go down, price pressures come down. You can see it going into the dot-com bubble right here. Imports came tumbling down, so did inflation. We can see it during the global financial crisis, obviously during the pandemic when everything was shut down. But look at now. You keep hearing that inflation's going to be sticky, it's going to rebound, and there's absolutely no indication. In fact, if anything, it tells us that the CPI report next week is going to come down even more. And when we tackle that with import prices validating that demand in terms of quantity goes down, the price too follows. Here you can see a very tight relationship between the import price index of all commodities against the consumer price index in red, again suggesting consumer prices are indeed coming down. And so this all kind of just backflows now as we get to the JPMorgan report of what they just said makes absolutely no sense, because I wanted to set the stage for you that the global economy was slowing down, that consumer demand in the U.S. is slowing down, and the price pressures are slowing down. Now, the question you have to answer is, does that mean that we're set for a second half rebound or a second half slump? Well, according to JPMorgan, they think it's going to boom. JPMorgan scraps U.S. recession call amid spreading optimism, which baffles me completely. The bank, which had previously expected a recession to begin in 2023, now sees continued expansion this year and modest subpar growth in 2024, taking the recession call off the table. Here we can see from their lead chief U.S. economist that the health of the non-inflationary growth, thanks to potential this productivity gains from AI and a pickup in labor supply. Now that baffles me, the labor supply, because if we look at the labor force participation rate, it's still below where it was before the pandemic, and that doesn't actually seem to mean anything. In fact, if more people are going back to work, it means they're struggling financially. So that doesn't actually tell us that that means the economy is booming at all. It actually makes no sense why he mentioned it. The likelihood of a contraction has diminished in recent months. A relatively quick resolution of the debt ceiling has taken one type of financial crisis risk off the table, while regulators' implicit guarantee, which I didn't think they were doing anymore, of bank deposits has vastly reduced the odds of a different type of financial crisis risk. Well, I got news for you, JPMorgan. Even though you love buying up failed banks, don't be surprised if there's a whole lot more that go down and that you get a chance to pick up some more. We'll see how that plays out because we know it's coming.JPMorgan now expects U.S. GDP growth to grow at a healthy 2.5% annualized pace, which I'm about to bust here in a moment, in the current quarter, followed by 1.5% in the fourth quarter. They anticipate that the unemployment rate will climb to 4.5% by the end of next year, a full percentage point above where it is now. And here you can see real GDP in blue, and I've got it overlaid against U.S. regular all formations gas price. And I know you're thinking, wait a minute, can there really be a relationship? Well, think about this. The brilliant thing about the energy sector, it shows demand. When an economy is expanding, it needs and uses more energy. And so sure enough, if you see the demand for energy fall, well, the economy slows as well. And here you can see what a great relationship this is, showing that as gasoline prices on a year-over-year rate of change decline, well, GDP growth starts to slow. We see that trend repeatedly happen. And when we see gas prices rising, well, we see, of course, GDP rising and running steady. So now the belief is that we've hit the bottom and this is going to rebound. Meanwhile, gas prices say, not a chance. And more generally, the note pointed to the continued resiliency of the U.S. economy in recent months, alongside a gradual moderation in core inflation. Wage growth, meanwhile, which I've punched massive holes in the last couple of shows, has also eased without a corresponding rise in unemployment. Well, at least not yet. But he noted that the risks to the outlook remain, suggesting that they're not sure about what they're saying. But let's take a look at this claim that employment's just not going to go up that much. Well, here we can see total compensation in blue. This is the average weekly hours multiplied by the average hourly earnings for production and non-supervisory employees. You got that on a year-over-year rate of change, and we can note that it's slowing down. And you can see periods, particularly going into a recession, when you have a large slowdown in total compensation, it's met by an increase in the 4-week moving average of initial claims. You can see that here in the global financial crisis. You can see that during the dot-com bubble. You can see there was a soft recession here kind of in 94, 95. You can see the data there. You can see it in the 1990 recession, and you can see it building now because, again, we kind of come back to this topic because it's important to understand that if consumers have less money to spend, well, then that means they end up spending less money. And if they don't go to the store as much, then guess what you don't need as much of if you're a retailer or a wholesaler or any of those type of people? Well, you don't need as many workers because you don't have as many customers. And next thing you know, it becomes a self-fulfilled feedback loop. As spending drops, unemployment rises, and sure enough, that's what we should expect. And it may not happen immediately, but there is a point that this number, the 4-week moving average, will indeed head higher. And adding to our story earlier, shipping companies are on a spending spree as capacity will grow more than trade, suggesting that disinflation and maybe even deflation is coming to the shipping sector. As deliveries this year alone are expected to add 1.5 million TEUs, or about 6.6% of the total fleet before adjusting for demolitions. Net new capacity is expected to increase by a record 1.82 million TEUs next year and 1.4 million in 2025 to reach 30.5 million, up almost 55% from a decade earlier. We're looking at the biggest order book in container shipping history. These companies have cleaned up their balance sheet and are now reinvesting, and what they're doing is they're reinvesting in global disinflation, which will likely add to the deflationary forces that we're already seeing in the money curves, we're already seeing coming in the data, and in a matter of the next couple of years, there's going to be excess capacity in the shipping space, and it's going to lead to even lower and lower prices. Thus, it makes no sense why JPMorgan is saying, look, we're calling off our recession view. Well, you should add it back, because everything is suggesting that if the consumer doesn't come out and start spending, and the data right now suggests there's no sign of that happening, other than saying, well, maybe by the holiday season, maybe after the end of the new year, they're not coming back. And if they don't, then a recession is all but a certainty. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.